Hello, dear friends. My name is Nathan, and I need you to listen closely because the next 48 hours are not just another 2 days. They are a stress test. Not because I'm here to sell you fear, not because I'm predicting a guaranteed disaster, but because modern finance doesn't break the way people think it breaks. It doesn't break with a single dramatic headline and a slow-motion collapse. It breaks when the clock demands performance and the system can't deliver smoothly. In other words, crises don't begin with panic. They begin with a deadline. They begin when cash has to show up, collateral has to clear, margin has to be met, and somebody who looked perfectly fine yesterday suddenly can't fund tomorrow morning. And the most dangerous part is this: the global financial system can look normal right up until the moment it seizes. It can look liquid right up until the moment bids disappear. It can look stable right up until the moment a chain of promises meets a hard clock and the clock doesn't negotiate. So when you hear the title, 48 hours that could crash the global financial system, do not hear a prophecy. Hear a mechanism, a short window where obligations can bunch up, pressure can concentrate, and small problems can become forced problems. And I'm going to anchor this immediately so you don't feel like this is fear content. Over the next 48 hours, risk rises when 3 mechanical forces overlap. 1. Scheduled positioning events. Think large derivatives expiries and dealer hedging flows that can flip markets quickly. 2. Scheduled cash flow events. Think large settlements, auctions, rollovers, rebalancing. Events that pull and push cash through the system on a timetable. 3. Risk control recalculations. Margin and collateral rules tightening after volatility, which forces leveraged participants to raise cash fast. When volatility is already elevated, that overlap becomes dangerous because it turns normal moves into forced moves. And forced moves are where systems reveal fragility. Now I'm going to do this professionally. No doom theater, no vibes, just plumbing, signals, and falsification. 3 things. First, what a 48-hour crash window actually means in a modern system, and why it has almost nothing to do with what the internet is arguing about. Second, a clear domino chain, exactly how a volatility spike can become a liquidity event, then a funding event, and in the worst case, a settlement confidence event. Third, a real-time checklist of what to watch and where to check it, plus a falsification test that can prove me wrong, because if a framework cannot be falsified, it's not analysis, it's performance. Now, one micro favor, and I'll keep it short. If you want more analysis like this, mechanisms, signals, and falsification tests, hit subscribe. All right, let's get into it. Most people misunderstand systemic risk because they think a crash is just a big red candle on a chart. They imagine the stock market drops, the news screams, everyone panics, and that's the crash. That's not a system crash. A system crash is when the machine that clears promises starts to wobble. Because the global financial system is not one big pile of money. It is a network of obligations, promises, and rollovers. And the network runs on an operational assumption that is so normal you barely notice it until it breaks, that funding will roll, that collateral will be accepted, that payments will clear, that market makers will quote, and that deadlines will be met smoothly. The most dangerous sentence in finance is not prices are down. The most dangerous sentence is I can't fund it, because the moment someone can't fund an obligation, the system doesn't just shrug, it tightens. Counterparties become defensive, rules stiffen, haircuts rise, terms shorten, cash becomes precious. And once that happens, the system can move from calm to chaotic quickly. Not because people are emotional, but because the machine is protecting itself. So here's the core concept, and I'm going to say it once, and then we're going to move forward. Belief changes slowly. Constraints change fast. Belief is a narrative. Constraints are deadlines. And when deadlines bunch up in a tight window, time becomes a weapon. That is what the next 48 hours represent. A window where deadlines can bunch and where the system may be forced to show whether it is confident or defensive. Now let me make this tangible with a simple mental model. Imagine the financial system as a chain of promises. Promise 1, I will deliver cash. Promise 2, I will deliver securities. Promise 3, I will post collateral. Promise 4, I will make a market. Promise 5, I will roll my funding. Promise 6, I will meet margin. All of these promises are connected, and they are not ideas. They are contracts. They are operational obligations. Most of the time, those obligations are handled so smoothly that we forget they exist. Settlement feels automatic. Funding feels continuous. Collateral acceptance feels like a background feature of reality. In a stress window, those assumptions get tested, And if they get tested hard enough, you get the kind of market behavior that makes people say, this feels like the system is breaking. Now, why 48 hours? Why not 48 days? Why not 48 minutes? Because the system runs on schedules and cycles. In a 2-day window, you can have an overlap of settlement cycles demanding cash and collateral at specific times, margin recalculations reacting to volatility in specific time frames, derivatives expiries forcing hedging flows into a narrow band of time, government cash flows and auctions pulling liquidity on a timetable, institutional rebalancing and risk committee decisions happening on known calendar rhythms. When those overlap, the system can experience a concentrated demand for cash and collateral that is much more intense than usual. And intensity matters because it forces behavior, it forces action, it forces liquidation, it forces defensiveness. And this is the key. When action is forced, price becomes less about value and more about who has to do what by when. Now, I want to address the biggest credibility risk in any title like this because you're right to be skeptical. 48 hours could crash the global financial system is a huge claim. If someone says that with no anchors, it's fear content. So here's the responsible adult framing. A 48-hour window becomes high risk when two conditions are true at the same time. Condition 1, there is a known cluster of scheduled obligations. Expiry, settlement batch, auction, rollover, rebalancing, something that concentrates flows. Condition 2, volatility is already elevated, which increases margin sensitivity and increases the chance that risk controls tighten. If those two conditions exist together, the probability of a stress event rises. Not certainty, probability. And you can validate that yourself without trusting me. You can check calendars and observe behavior. So the right mindset is not disaster is coming. The right mindset is this is a stress window. The system will either absorb it smoothly or it will show us it's defensive. Now let's talk about what defensive looks like, because the system reveals defensiveness through symptoms long before the public narrative catches up. Defensiveness looks like spreads widening, liquidity thinning, rules tightening, haircuts rising, margins increasing, funding tone turning cautious, counterparties shortening terms, dealers reducing balance sheet usage. And the most dangerous part is that these symptoms can feed on each other. That's why I'm going to give you a domino chain you can visualize. Here is the realistic domino chain of a 2-day systemic stress event. Step 1, a shock hits a liquid market. It could be rates, it could be FX, it could be equities, it could be a large commodity, it could be a policy surprise, it could be a credit event. The spark can vary. What matters is the reaction. Step 2, volatility rises and risk models react. Brokers and clearinghouses tighten risk controls. Margins rise. Collateral requirements rise. Haircuts rise. Leverage becomes more expensive. Step 3, leverage participants who cannot meet the new collateral demands are forced to raise cash quickly. They sell what they can, not what they want. And that often means selling liquid assets first. Step 4, forced selling creates air pockets. Market makers widen spreads or step back. Prices gap. The tape gets jumpy. Correlations spike. Assets that normally diversify each other start moving together because the real trade becomes raise cash. Step 5, funding markets reprice. Short-term cash becomes more expensive or less available. Rolling becomes harder. Dealers shrink balance sheet. Lenders become selective. Step 6, counterparties become defensive. They demand more collateral. They shorten terms. They reduce exposure. And that defensiveness increases collateral demand even more, which forces more selling, which worsens liquidity, which worsens the cycle. That chain is how a volatility event can become a liquidity event, and how a liquidity event can become a funding event, and in the worst case, how a funding event can threaten settlement confidence. Now, I want to add a balancing line right here because I am not interested in doom theater. Most of the time, the system absorbs these shocks. Backstops exist. Liquidity tools exist. Institutions de-risk. The machine keeps running. So we are not assuming disaster. We are watching for confirmation, and confirmation has a fingerprint. Now, here is the difference between people who stay rational in stress windows and people who become liquidity. Rational people watch constraints. Emotional people watch narratives. Narratives are cheap. Constraints are real. So let's talk about the constraints you can actually watch, and I'm going to make them checkable. You do not need 50 indicators. You need a handful grouped into 3 buckets: credit stress, funding stress, volatility, and liquidity stress. If you monitor those 3 buckets, you can tell whether the system is absorbing or escalating. Now let's go bucket by bucket. Bucket 1, credit stress. Credit is where downturns and crises often begin because credit is upstream of business behavior. When investors demand much higher yield to hold risky corporate debt, that's tightening financial conditions. That's fear with numbers. A simple, widely discussed proxy is high-yield credit spreads. Many people watch high-yield option-adjusted spreads as a barometer of risk appetite in corporate credit. You don't need to become a bond trader to understand this. The question is simple. Are spreads widening quickly and persistently? Because if spreads widen rapidly, it signals that lenders and investors are becoming more cautious. And if lenders become cautious, the real economy feels it. Bucket 2, volatility stress. Volatility is not just the market being dramatic. Volatility is a force that changes margin and collateral demands. When volatility rises, risk models demand more protection. That protection becomes margin increases and haircut increases. That can force deleveraging. So when you see volatility spiking repeatedly rather than calming, it's a warning sign that the system is struggling to clear. A one-off spike can be absorbed. Repeated spikes imply instability. Bucket 3, funding stress. Funding is the heartbeat of systemic risk. It's the difference between prices are down and the machine is seizing. When short-term funding becomes tight, leverage becomes fragile. Rolling becomes uncertain. And uncertain rolling is where forced selling is born. Even if you don't have professional access to repo screens, you can still watch funding tone and proxies. You can watch short-term reference rates, you can watch credible reporting for repeated mentions of funding tightness, and you can watch whether institutions begin talking about balance sheet constraints. Now let's make where to check practical without turning this into a data dump. If you want a simple dashboard, you can look at twice a day during a stress window. It's this: credit, high-yield credit spreads, volatility, a broad volatility gauge, and a rates volatility gauge if you follow rates, funding, a short-term rate reference, and the tone of repo and liquidity commentary in credible sources. Liquidity, bid-ask behavior, gappy price action, and any visible dislocations in widely held instruments. Rules, watch for margin increases and tightening terms announcements. That dashboard is enough. Now, let's talk about one more underappreciated mechanism that explains why things can look weird in stress windows: cash scrambles. In a cash scramble, people sell the good stuff first. They sell what they can, not what they want. They sell what is liquid. They sell what still has bids. That's why you can sometimes see assets that are normally safe dip during a stress event. It's not because they're suddenly unsafe. It's because cash is demanded now. So if you see weird correlations, don't assume the world is broken. Often it means liquidity is dominating fundamentals. Now, I want to connect this to the real economy because people think systemic risk is just a Wall Street problem. It isn't. Financial conditions are upstream of hiring and spending. If funding tightens and lenders get cautious, credit becomes more expensive or less available. When credit tightens, businesses slow spending and expansion. When businesses slow, hiring slows. When hiring slows broadly, recession risk rises. This is why credit spreads matter even if you never trade a bond. This is why funding tone matters even if you never touch a repo instrument. Because the real economy runs on financing too. It runs on working capital. It runs on inventory financing. It runs on payroll planning. It runs on corporate borrowing. It runs on consumer credit. Now, here's a mini scenario that makes this feel real. Imagine you run a company that depends on short-term financing to manage inventory and payroll. You don't keep a year of cash sitting idle. You operate, you roll, you manage. In calm conditions, your bank is relaxed, your credit line is stable, your suppliers give you favorable terms, and you ship product. In a funding stress window, rates jump, terms tighten, suppliers get cautious, banks ask harder questions, and you suddenly shift into defense. You freeze discretionary spending, you delay hiring, you reduce inventory orders, you push for faster payments, you conserve cash, and when thousands of companies do that at the same time, it becomes an economic slowdown. Not because they got emotional, because the financing environment forced caution. That's how financial stress becomes economic stress, through countless defensive decisions. Now, let's address a crucial point for credibility. Most of the time, a 48-hour stress window ends with absorption, not collapse. So why talk about it? Because stress windows reveal information. They reveal whether the system is confident or defensive. They reveal whether liquidity is abundant or fragile. They reveal whether risk controls are stable or tightening. They reveal whether funding is smooth or jumpy. They reveal where leverage is hiding. So this isn't about predicting collapse. It's about recognizing risk regimes. Now let's make the language precise so we don't sound like doom content. When people say global financial system crash, it can mean different things. It doesn't always mean markets go to zero. It can mean the machine temporarily freezes. It can mean liquidity evaporates. It can mean funding costs spike. It can mean authorities intervene to keep plumbing flowing. So I'm going to give you a hierarchy that makes this precise. Level 1, volatility event. Markets move violently, but funding holds. Scary, but often contained. Level 2, liquidity event. Market depth disappears. Spreads widen. Forced selling rises. Correlations spike. More dangerous. Level 3, funding event. Short-term cash tightens. Rolling becomes hard. Haircuts rise. Dealers step back. Systemic risk territory. Level 4, settlement confidence event. Counterparties question performance. Collateral hoarding accelerates. Authorities intervene. This is what people mean when they say the system is breaking, even if indices don't go to zero. So the professional way to interpret the title is this. The next 48 hours are a window where the system could move from level 1 into level 3 if deadlines and constraints pile up and the system turns defensive. That's the claim. Specific, bounded, and falsifiable. Now let's talk about falsification because this is what separates analysis from drama. What would prove this stress window thesis wrong? If over the next 48 hours you see volatility cooling rather than spiking repeatedly, credit spreads stable rather than widening sharply, funding conditions orderly rather than jumpy, liquidity holding rather than spreads blowing out, no aggressive rule tightening, no fresh wave of margin increases and collateral clampdowns. If those are true, then the system is absorbing the stress. The window passes as a contained episode. That's the falsification test. Simple. Now, what would confirm risk is rising? Not one indicator, a cluster. Repeated volatility spikes, rapid widening in credit spreads, funding tone turning defensive across credible sources, bid-ask spreads widening and gappy price action in normally liquid markets, a fresh wave of margin hikes and tightening collateral terms, multiple confirmations together. Now here's another element people miss that matters in a 48-hour window. Forced sale lines. A forced sale line is a point at which your position is no longer yours. Margin calls, stop-outs, liquidation thresholds, risk limit triggers. In stress, the market finds forced sale lines because forced sale lines create predictable flows, and predictable flows create cascades. So here's a brutal question you should ask yourself going into any stress window. Where is my forced sale line? If you don't know, you are not in control. And if you are not in control, your job is not forecasting. Your job is survival. Now, I'm going to give you a practical response framework for the next 48 hours that doesn't require you to predict anything. First, reduce decision frequency. Stress windows punish people who feel the need to act constantly. If you don't have a tested strategy, doing less is often smarter than doing more. Second, reduce leverage and forced sale risk. If you're leveraged, your enemy isn't price. Your enemy is margin and time. If you can't fund the position through a volatility spike, the market will take your position at the worst moment. Third, increase optionality. Cash is not a position until it is. In a stress window, cash is flexibility. Flexibility is a weapon. Fourth, write your plan down, not in your head, on paper. What will you do if markets gap down overnight? What will you do if they rip up and reverse? What is your maximum loss? What is your rule for doing nothing? Write it before volatility writes your emotions. Now, I want to address the temptation that ruins people in these windows. The temptation to treat volatility as entertainment. Whiplash markets are designed by mechanism to extract emotion. They punish confidence with sudden drops. They punish panic with sudden rebounds. They punish impatience with randomness. If you react emotionally to every move, you become the fuel for someone else's discipline. So remember, you're not competing against the chart. You're competing against your own impulses. Now, I want to add one more piece that improves the script's credibility. The idea of known cluster, without pretending we know exact details in this moment. I am not claiming one specific event will trigger collapse. I am saying the risk rises when scheduled obligations cluster. That's why I keep using the word cluster, because clusters are checkable. Options calendars are checkable. Auction calendars are checkable. Settlement cycles are knowable. Margin updates are observable. So the framework is confirm cluster, then watch stress signals. Now, let's talk about the system's tell when stress rises, rules and terms. In calm periods, rules are stable. In stress, rules change. Margins rise. Haircuts rise. Position limits tighten. Settlement terms get stricter. Counterparties ask for more collateral. Dealers quote less size. These are not random. They are the system closing its watertight doors. And that metaphor matters because it's a physical truth. When a ship closes doors, it's not because the sea is calm. Now, another signal that matters is correlation. When the system is healthy, assets behave differently because their fundamentals differ. When the system is stressed, assets move together because the dominant trade becomes cash. So if you see correlations spike, if you see things that normally diversify start acting the same, that's a sign liquidity is dominating fundamentals. Now I'm going to close with a two-scenario framework for the next 48 hours that keeps your brain clear and stops you from swinging between euphoria and panic. Scenario A, absorption. Volatility cools, credit spreads stay contained, funding remains orderly, liquidity holds, rules remain stable. In that scenario, the system passes a stress test. Markets can remain volatile, but the machine keeps running smoothly. Scenario B, escalation. Volatility spikes repeatedly, credit spreads widen quickly, funding becomes jumpy and defensive, liquidity thins, spreads widen, gaps appear, risk controls tighten again, margins up, haircuts up, balance sheet down. In that scenario, we are no longer watching a price event. We are watching the machine become defensive, and defensive machines create self-feeding loops. Now here is the cliffhanger that actually matters. In the next 48 hours, will the system behave confident or defensive? Confident systems don't hoard collateral. Defensive systems do. Confident systems don't tighten terms suddenly. Defensive systems do. Confident systems don't need rapid margin escalation. Defensive systems do. So watch behavior, not narrative. And now I want you to answer two questions in the comments because it forces clarity and it helps the community focus on signals instead of emotions. First, what scheduled cluster do you see in the next 48 hours? Options expiry flows, auctions and settlement cash flows, margin recalculations, and which one do you think is the biggest pressure point? Second, if you could watch only one real-time gauge, would you watch credit spreads, volatility behavior, or funding tone, and why? And one last micro CTA, clean and premium. Subscribe for the follow-up because the follow-up is where we'll see which scenario won, absorption or escalation. Ladies and gentlemen, my name is John A.G. Stay calm, stay disciplined, and write your plan before volatility writes your emotions. Bye-bye for now.